Good day, fellow Marty alumni. My name is Bobby Wessels, and I am a tax consultant from a boutique tax firm in Cape Town called AJM Tax. We're a contingent of fellow Marty alumni that specialize in everything tax-related. This is the first episode of the latest How To series brought to you by the Alumni Office. And in this specific episode, I'm here in the beautiful new Young Alumni Clubhouse. I look forward to joining you all here once we are allowed to venture back to the university, potentially towards the end of this year, and to meet and network with fellow Marty alumni. In this series, and for the first episode, you've been given the pleasure of joining me on a journey through some of the tax questions and considerations that you should consider, at least every day in your life, if you ask me, but potentially just in certain parts of the year, and we'll get to that a little bit later. So join me as we go through a little bit of Tax 101 to Tax 301, at least the last part being for those of us that are slightly more familiar with the tax return and certain tax considerations in our own personal lives. Essentially, the first question you need to ask yourself is, when do I need to pay tax? And I think for a lot of us, the thought has always been that I'll pay tax the day that I leave university and get my first proper job. The reality is, that's not quite the case. In fact, you'll need to pay tax on any income that you earned, whether you earned that while being a student, after your studies, maybe looking for a job, or then eventually when you do find that first elusive job. If at first consideration you're thinking, ooh, I have some income that I earned whilst being a student, and I never paid tax on that, is there a problem for me? Then this video is exactly for you, because these are the types of questions that I'm going to be running through. So the main question you need to ask yourself is, when do I need to pay tax? And I think a lot of us always thought that potentially I need to pay tax the day that I find that first elusive job. You might find out throughout the series that that's not quite the case. And what actually needs to happen is you're liable to that to pay tax in South Africa on any income that you earn. Now, income is a broad term. For those accounting students, I'm sure they deal with it every day. But for those of us that aren't so familiar about it, income is essentially any money that you earn from doing something. Now, there are exceptions to this, but in broad terms, for those of us watching and listening to this video, it would be any money that you've received whilst working, whether that be in a professional capacity in your first job, or maybe while you were at university. Now, some of you may think that while you had a job while you were at university, and wondering whether you now have a problem. Did you have to pay tax on the income that you received from that job? Maybe working for the university as a HARCA member, maybe at the alumni office, or potentially waitering, as many students end up doing. Now, that answer is slightly complicated, but the easy one is that potentially there were no tax consequences for you. And that relates mainly to what is known to us as the tax threshold. The tax threshold is an amount that varies slightly every year, and it may have been a little bit less when you were a student. However, currently the tax threshold is at 87,300 Rand. And what the tax threshold essentially means is that the tax that you would be payable on your income received for a year of assessment, being from the 1st of March to the 28th of February for any year, had that income been less than 87,300, there would be no tax consequences for you on that specific income. So if you did earn any income from any other form of a job, and that income for that year of assessment was less than the tax threshold, then there would be no tax liability for you. And that's probably the reason why you never ended up paying any tax on that amount anyway. So in this episode, what we're going to be looking at is firstly, when you become liable to pay tax in South Africa. Secondly, how do you declare that tax? Essentially going to be looking at e-filing and how that works. Thirdly, we're going to look at some tax terminologies that you might have heard before. Fourthly, and quite interestingly, we're going to look at the two different types of taxpayers that you get and how the consequences may differ slightly in respect to your compliance depending on which taxpayer you find yourself to be. And then lastly, for those of us that are familiar with all four of the above, it's going to be that 301 part of this episode, which is going to be looking at slightly more complicated things that may affect us in our daily lives. Now, a lot of people also ask sometimes is, what can I do to lessen my tax liability? And the answer typically is that if you only earn a salary, there's not much that you can do to lessen your tax liability. For those of us entering the workplace for the first time, you'll be pleasantly surprised to find out that there are in fact two ways that you could lessen your tax liability. The first is with contributions to any sort of pension fund or pension scheme, typically a retirement annuity, a pension fund, or a provident fund. Secondly would be any contributions that you make to a medical aid. And those contributions would typically be taken into account as part of your rebate, which is a deduction off the tax that you owe SARS at the end of the day. So for many of you that have completed your tax returns previously, you would have been pleasantly surprised at the end to see that there's a refund and that SARS actually owes you money. Now typically that refund would have come about because of either of the above mentioned deductions. Either deductions because of a contribution to a retirement fund of sorts, or secondly, because of a rebate that originates from your contributions that you make to your medical aid. Now that we're familiar with when you become liable to pay tax, it may be worthwhile for us to consider how you declare those taxes and what the process is involved in that regard. Now the first thing that you'll need to do is you'll need to open an e-file account for yourselves. That you can do by merely Googling e-filing, clicking on the first link, and then following the prompts to open an account for yourselves. Typically, you'll need your ID and a residential address. Now, I was hoping that I would give you some carrots of gold throughout this episode, and this might just be one of them. For those of you that have previously worked for the university, this specific type of advice may be exactly for you. So what the university typically does when you work for them, either in a capacity as an assistant or maybe as a HACA member, is they open a tax number for you, and which tax number your employer will require. Now to get that tax number may sometimes be somewhat of a tricky process, especially once you've left the university. So my suggestion would be that you go to HR whilst you're at the university and try to obtain that tax number. Because what typically happens is that you would need to call SARS, and to try and confirm that tax number, they require certain security details that need to be answered. Sometimes we are uncertain of which security details the university used, such as the telephone number that the university put down, or maybe even the address. And as a result, the only way to thereafter get your income tax number is to physically go to the SARS branch. So my suggestion would be to approach HR beforehand, if you can. And if you don't have that luxury, unfortunately, you will need to contact a SARS branch. Alternatively, if you still can't come right, I'll leave my contact details at the end, and you're welcome to contact me to see if I can't put you on the right path. Now for some tax terminology. So there are certain terms that you need to become familiar with right now that you're going to need throughout your entire life, but specifically in the beginning of your employment career, which may be slightly foreign to you. For those of you that are well versed with these terms, I humbly do apologize. So the first one is an IRP5. When I first started off in the working world, the term IRP5 was foreign to me as well. Now I know that everyone always asks for IRP5, and specifically SARS. It's definitely one of their most trusted documents. An IRP5 is basically just a document from your employer to show the income that you have earned, the tax that they have withheld on that income, known as pay-as-you-earn, and you'll see that we'll get to pay-as-you-earn just now, and then the corresponding tax numbers to which those income have been completed. An IRP5 is something that generally pulls through to your returns automatically. So it's something that you don't need to be too worried about, because it will, in all likelihood, already be there once you go to file your return. The next term that you should be familiar with, in fact, they go hand in hand, is the IT3B and the IT3C. The IT3B is typically a document issued by your bank that shows the amount of interest that you have accumulated throughout the given tax year. Now, you would have seen on one of the previous slides that it mentioned interest of 23,800. That's the amount of exempt interest that each individual is entitled to every year. Now, you may ask yourself, what is exempt interest? And in layman's terms, what it means is it's the amount of interest that you can incur every year without a corresponding tax charge on that interest. The IT3C is the corresponding document that shows your gains and losses, typically on the sale of shares, for example. This can be obtained from the online platforms that you use or specific service providers, such as Easy Equities or Allen Gray. These are then used as evidence to show to SARS what shares you have disposed of and what the gains or losses are that you raised on the disposal of those shares. Another term that many of you may not be familiar with is bracket creep. Now, bracket creep essentially is when the various income tax tables that the South African tax regime has are increased with at least inflation. This means that if your income increases with inflation, that you won't necessarily jump into the next bracket, but that you will be taxed at the same rate, or at least at the same marginal tax rate that you would have in the previous year. The avoidance of bracket creep is essential for us as tax-paying individuals, and it's something that you should keep a key eye on every year at the budget speech, because it is something that typically the Minister of Finance will announce. The last term, PAYE. PAYE, or pay as you earn, as I mentioned earlier, is essentially the amount of tax that is withheld from your salary by your employer. Your employer will calculate the annual tax due on your gross employment income, after which it will rework that calculation to a monthly amount. That monthly amount will be withheld from your monthly payment every month and is essentially your upfront payment of tax to the South African Revenue Services. Knowing what PAYE means lends us nicely into the next topic, which is what is the difference between PAYE and a provisional taxpayer? A provisional taxpayer is someone that earns income either outside of their normal remuneration for which PAYE is withheld, or someone that performs services for which no PAYE is withheld at all. And it's important that you understand this distinction. If you're a normal employee that merely earns a salary and you earn no income in any other form, be it from trading income such as the leasing of immovable property or a side business that you might have, then provisional tax is not something to be worried about. However, if you earn income other than just the employment income which you have, then potentially you need to consider whether you're not maybe a provisional taxpayer. There are some hefty penalties that go with the filing of provisional tax, so it's something to be aware of and to make sure every year that you don't miss any of those deadlines. Now for the 301 part of our discussion, and this part pertains specifically to shares and the various treatment that goes along with the holding of certain shares. Now the first one that you always need to consider when you have a share portfolio, for example, is when you sell certain of your positions in that portfolio, whether that amount should be taxed on income or capital basis. Now, there's some legislative reform that has really helped to simplify what is really probably one of the most litigated questions in the South African tax regime. What the legislative reform essentially is it says that there where you hold a share for longer than 3 years, the tax payable on that share will only be on your capital account. Now, why is there a difference? Why is it so important to distinguish between a share held for capital purposes and one held for income purposes? Well, the effective rate on capital gains tax for a South African tax-paying individual is only 18%, whilst on the other hand, that share, if taxed on income account, will be taxed at a potential effective rate of 45%. So a clear disparity between the two, and it being very important for you to distinguish into which of these two regimes you fall and on which basis tax will be due. So if you do hold a share for 3 years, it means that automatically that share will be regarded to have been held on capital account. Now, if you don't hold a share for 3 years, what happens then? Well, essentially we need to turn to case law. And there are various cases that set out various guidelines for how we determine whether that share was held with a capital or income motive. And for purposes of this video, the main thing that you need to keep in mind is that it all relates to your intention and your purpose. If you hold that share with the intention of embarking on a scheme of profit making, then that share will be regarded to be for income, for your income account. Alternatively, if you hold that share with the idea of maintaining a long position on it and holding it for a substantial amount of time, it would mean that that share would more likely than not be for your capital account. For many of us moving up in the working world, there are also other shares that may come into play, other than those which we hold on the stock exchange. As an incentive, our employer may want to grant us certain shares. It's just always important to remember that typically any shares that you gain from your employment relationship or by means of your employment would typically be subject to Section 8C. Now, Section 8C is a complex legislative regime and one that I certainly do not have enough time to explain to you today. However, I would suggest that you speak to someone that has knowledge on this regime, or at least just bear cognizance of the fact that when your employer offers you this chance, that you ask the right questions so that you're aware of what the typical tax consequences may be. Ultimately, the tax world is complicated, and some of the principles that I've spoken about today may not be as simple as I've tried to make them look. A lot of times, things are more complicated than we realized, and it's always good to be abreast of the new changes happening in the tax regime as it changes year on year on year, and keeps us as tax professionals certainly on our toes. If you have any questions, if there's anything that you're worried about or that you would like to talk to me about, I'm happy to reach out a hand to my fellow Marty alumni. My contact details are on the screen now, and you're welcome to reach out to me. Thank you very much for taking this time to listen to me, and hopefully I've shared something that is somewhat insightful to you in the world of tax.